Not only we're going to talk about some simple valuation models, we will also talk about the nature of the stock market, how it operates, who are the players, and that sort of stuff. We're going to start with what's going on with my pens. The so-called dividend growth model. This is not necessarily a stock valuation model that I would use in practice, but it's a good teaching tool because a lot of other methods that we use in practice are kind of fashioned from the mechanics of this. We start by asking the question, what are the cash flows from owning a stock? So what do you think? You bought 100 shares of NVIDIA? Well, that means you got about $18,000. And about 3 years ago, that 18,000 was about 3,000. Not even 3 years ago. So what do you expect as cash flow from this ownership? What sort of, I mean, when you buy bonds, you get the coupon payments plus at maturity, you also get the face value, right? How about stocks? What sort of cash flow it generates for you? Or what do you expect? Hmm? I didn't ask why you're buying it. That is true. But what sort of cash flow do you get to, do you expect? Dividends is one of them. Okay. So these guys are going to pay dividends. Not all companies pay dividends, but a lot of them do. What else? Now we can come back to you. You expect it to go up. It's basically capital gains. Dividends are part of the return, but I spent $6,000 or $3,000 on those NVIDIA stock 3 years ago. I do get some dividends, which is not much, but right now it's 18,000. So they change from 15,000 or 3,000 to 18. That $15,000 is called the capital gain. So your total cash flow from this is sum of dividends and capital gains. When we're valuing a bond, we kind of had it easy. For example, for fixed coupon bonds, we knew exactly how much cash we were going to get and when, right? If I'm holding a 8% coupon, 30-year semi-annual bond with a face value of 1,000, I know I'm going to get 60 coupons of $40 for the next 30 years, and I'm going to get another 1,000 30 years after now. Given that, and given that we had something to discount it with, the so-called yield to maturity, we can calculate the value. The problem with stocks, even if you knew what the dividends were going to be, you have no idea how much capital gains you will have. Well, if you did, then everybody would invest into stocks that will go up, and nobody would invest into stocks that would go down. That immediately changes prices anyway. So we kind of need to do some bootstrapping. So we're going to start simple. And when we said capital gains, we didn't say anything about how long we're going to hold these stocks. Am I going to hold it for 1 day, 1 year, 10 years, ad infinitum, which is a fancy way of saying in Latin, until infinity and beyond. So let's start simple. My computer is already not liking me. I swear I'm going to get a Mac next time. Or I'll try to figure out a way to connect an iPad to these. Because we don't have Microsoft problems in iPad. So I'm going to do a simple trade. I'm going to buy a stock at a certain price. We're going to call that P0. Hold it for 1 year and sell it 1 year from now at a price of P1. I mean, we don't know what that P1 is going to be, but there will be some price. In the meantime, you also expect to get D1. I'm going to call this dollar D1 in dividends exactly 1 year from now. Yes, dividends are typically paid quarterly, but you're keeping things simple. So if someone told you what that P1 was going to be, you could actually calculate the value. Assume that proper discount rate for the stock is some R. Just like we use risk adjusted discount rates for projects, we're going to do the same thing for cash. Not all stocks are created equally in terms of risk. So if I knew that, let V0 designate the value of the stock. You don't have to be a Marxist to make a distinction between value and price. Of course, if you know nothing about the Karl Marx, you don't know what I'm talking about. Uh, to put it on a colloquially, price is what you pay for something, value is what you get for it. We'd like to think that if the markets are in equilibrium, uh, value and price are the same thing. We're kind of gonna go there. So if I know what cash flows I'm gonna get, that value is going to be, I'm going to get $D1 in dividends, but I'm going to get those 1 year from now. So I'm going to discount that at 1 plus R, right? So if somebody told me what the price 1 year from now is going to be, I could make this calculation. The trouble is, nobody knows what that price is going to be. So as it stands right now, this is not a very useful valuation model. So we're going to kind of iterate on this. We're going to say, okay, suppose suppose we